is from Oscar. What a lovely name. It says, "Hi, Pete." Not so lovely now.
Hi, and welcome to another Meaningful Money Q&A show with me, Pete Matthew.
And me, Roger Weeks.
What's your Roger?
Hi,
All
Pete.
right.
Yeah,
It's nearly at the end of February, and spring is in the air.
And in my step.
Is it? Oh, I'm so glad to hear that.
Oh, spring is sprung. The grass is riz. I wonder where the bird is. The bird is on the wing, but that's absurd. The wing is on the bird. So,
Hey, we're gonna get a copyright strike. There, I guess. Did you write it?
I don't know where that came from. No, I just
No, I don't know where you came from. Okay. Love it. Okay, where do people go if they want their questions answered?
Very seriously now. If you want your question answered, please send it to hello@meaningfulmoney.tv with the subject line podcast question. But let's just get into today, shall we?
The wing is on the bird. That was the weirdest 2 seconds of my life. Okay, let's get into the question. As always, remember, any links that we refer to are at the show notes. And you can ask any questions there as well if you want. So the show notes are at meaningfulmoney.tv/QA40. meaningfulmoney.tv/QA40. And just, it's a lot in it.
Yeah, it's a lot.
Ramping up. Help us out by liking the video as well, subscribing to the channel here on YouTube. That really helps us out. Thank you. Right. Question number 1 is yours, Rog.
Well, it's me. This is from Joy. He says, "Hi, Pete and Roger. Thanks for all your helpful and easy to understand information. I've only been on my financial well-being journey for a year.
Well done.
I work in the NHS and I'm in the higher tax bracket. I'm fully enrolled in the NHS pension, more out of previous disinterest than actual action on my part. I am single and currently saving up for a down payment on a house in about 4 to 5 years' time. I maxed out my ISA last year and I expect to do the same this year. Sure. This includes money for the down payment. I also took out a SIPP, which I only recorded last year. I took it out about 20 years ago.
Wow.
However, I'm still waiting for a statement from the pension office before my accountant can work out how much more I can add to the SIPP.
Okay.
In the interim, I have an emergency fund in a premium bond of £20,000, but I'm worried it's being eroded by inflation. I expect to be an additional taxpayer in the next few years. Where should I keep my excess cash? More in premium bonds with no tax but erosion of inflation, or open a GIA or more in high interest savings and pay the tax? Or is there another option you would recommend? By the way, I have £600 in crypto, Coinbase and Ethereum, but don't plan to move more than £400 into it and then plan to forget about it. It's a tiny fraction of what I put into my ISA. Thanks, Joy."
A little aside there. Okay. So, emergency funding premium bonds for a soon-to-be additional rate taxpayer.
Yeah, fine.
Moving on. So why is it fine?
The thing about an emergency fund, Joy, is that you need to access it when you need to access it. The fact it's going to be eroded by inflation to some extent is neither here or there. It's doing the job it needs to do.
Yes.
If you don't want it to be eroded by inflation, it's a different fund. It's not an emergency fund.
And I think, exactly right. It's about what that money is for, ultimately. Its sole job is to be there when you need it. Inflation is really an irrelevant factor. And I actually think inflation is less of an issue than tax, particularly additional on higher rates. I know you only pay tax on the interest, right? And on inflation, of course, affects the whole pot. But still, bear in mind, if you're going to be an additional rate payer, you're in the NHS pension, you're building up significant pension benefits there. And, you're obviously in a position where you're maxing your ISA. You're thinking of putting additional money into your SIPP on top of your NHS pension contributions. So the effect of inflation on 20 grand in a premium bond isn't even going to move the needle in the context of the overall wealth, I don't think.
And even if you're going to add to it, Joy, it's still not going to make that much difference. It needs to sit somewhere.
Yeah.
A lot of people use premium bonds for emergency funds because it sits there. You never know, you might get £1 million. You probably get a few checks back in return.
Yeah.
Get them reinvested in more premium bonds if you want to.
I guess our message here, Joy, is just not to overthink it. Don't sort of, I don't want to say stress out about it. That sounds a bit condescending. Just don't let this become something which you think about, which distracts you from the main things, which you're doing everything right, NHS pension, maxing ISAs, you're doing so much good stuff. Don't let this be something that kind of nags at you. Just stick it in there and forget about it, because you will do so much good on the other stuff that largely is there just to do its job, just to be there if you need it. Right, we got a perler of a long question here, which Nick, I think, did put, you might want to edit this. But actually, it's quite difficult, so I'll try and be as clear as I can. So, dear Pete and Roger, love the podcast. And then there's some nice words. Thank you, Stephen. This is from Stephen. Don't think I said that. So, my mother is 79 and has a comfortable, guaranteed inflation-linked income via state and civil service pension, which is supplemented by savings, maxed premium bonds and healthy cash, and investments held in ISAs, and a beneficiary SIPP from my late father, who passed before 75 years old. Therefore, the assets are income and CGT free, so the income paid to mum would be tax free as well. My mother is keen to minimise the inheritance tax on the estate both her and my father worked so hard to create. Despite her comfortable situation, I still have to encourage her to spend and use. I use your very helpful 40% off sticker analogy on a regular basis. And is that ours?
No, I
don't know. I've heard that. That might be somebody else's, but that's okay.
We've spoken
we'll take
about
it.
the 40% before, but not an actual sticker. But
It's quite a good idea.
It is a good idea.
Spend it now. It's 40% you're not paying to the revenue. Yeah, makes sense. It is my understanding that SIPPs will be subject to inheritance tax and income tax from 2027. Yes, because mother is 79 already. So as my sister and I are both additional rate taxpayers, we will be potentially subject to 67% tax on any assets remaining in the SIPP if the estate is above 1 million inheritance tax threshold. Yes. That's right. Sorry, just was double checking my maths then. While the 67% off sticker analogy is even more helpful to encourage her spending, it has triggered some planning. We are drawing down the beneficiary SIPP to fund an ISA each year for my mum. Important point. Keeping the income and CGT tax benefits for my mum while removing it from the double income and IHT tax on death. Sensible. To a point. To a point.
Yeah, to a point, yes.
As part of the IHT planning, we are now considering regular gifts from surplus income. When combined with a guaranteed income, the assets in the beneficiary SIPP are more than sufficient to sustain her lifestyle until her age would be well into 3 figures. Based on my reading, it appears any drawdown from SIPPs are considered income for gifting purposes, regardless if they come from capital income. Yeah, they are income. Therefore, she could start to draw more income from the SIPP and gift this surplus, which would be considered inheritance tax-free. Are there any limits to how much or how quickly she could reasonably draw down from a SIPP so that it would no longer be considered income by HMRC for inheritance tax purposes? I.e., could she empty the SIPP over a 5-year period, gift that as excess income, then reduce the gifts to reflect a different income and or expenditure? It's a great question. While all the drawdown from SIPPs is considered income for inheritance tax purposes, the treatment of withdrawals from ISAs and other investments are distinguished between whether they are actually capital or income. That's right. Therefore, we have the added complication of needing to balance the income from the SIPP to make sure she doesn't eat into the capital of the ISAs and savings, which would then mean the gifts from regular income would be considered part of the estate again. That's true.
Yeah, well thought.
Our circumstances mean my mum feels slightly trapped between keeping the SIPP so that it is considered income for gifts from regular income but gets inheritance taxed at 67, continuing to use the beneficiary SIPP to fund ISAs, which will reduce IHT liability but lose flexibility. Come back to that in a minute. To gift it as income, maybe change the investment engine of the ISAs from a lower yielding balance solution to something with a higher natural yield, or do something else altogether. Lump sum gifts and hope to survive 3 years for taper or 7 years for the inheritance tax to be all gone. Any thoughts or suggestions would be appreciated. While these are some relatively niche circumstances, I think it covers 2 more broadly applicable inheritance tax planning considerations: SIPPs versus ISAs under the new rules and regular gifts from income. Yeah, it does, Stephen. It's not niche, actually. You see this all the time. Okay. The thing is, I'm not aware of what the revenue would consider income, except to the degree that it needs to be regular.
Yes.
But I mean, I wonder if they would take, I don't know is the answer. I don't know if they would take a dim view of Stephen's mum suddenly taking an extra 50 grand in income.
And then giving it away.
But they ought not to, because it's income.
It's income. But I suppose it depends on how far they go back, because in my head, if Stephen doesn't say how much the SIPP is, does he? No. So say the SIPP was worth £200,000 and she says, okay, I'll have an extra 50 grand. Yeah. And in 4 years' time, the SIPP is gone, but she's given it out of income, which is legally allowed. It's not a problem at all. If then she's run out and she has to access capital then to give her living requirements, I wonder
how far they'll go back.
How far they'll go back and say, well, okay, you just emptied the SIPP, was giving your income. You're now needing capital. So do we look back? So I think, Stephen, there might be some sort of little balance here saying, okay, how long can we let this SIP survive for mum's income requirements whilst also giving away more of the income if we can?
Yeah. I mean, Stephen is right to, think about, well, currently she's drawing from the tax-free SIP to fund ISAs. Makes sense.
Mm-hmm.
But of course, if then, what's to stop? If she then has to draw from ISAs to supplement income, that makes less sense, I think. So we need to go in order. So we need to make sure her needs are met first.
Yes.
And wouldn't it make sense to draw from the SIP because it's tax-free? Wouldn't it? To meet her needs. Assuming
yes.
It's not fully covered by her civil service and state pension. If she has to supplement from her assets.
Yes, because obviously she's on a state pension and civil service pension. So she's into the tax bracket anyway. So anything else she takes from a taxable source will be taxed at least 20%.
Yeah. So, she could spend the money she's got in cash or premium bonds or whatever, but I would have thought a tax-free SIP would be a pretty good place to draw what excess she needs from, wouldn't it?
Yes.
So that would be a good place to start. And potentially then more, sorry.
Oh, I was just thinking, because Stephen also mentioned the fact that mum's got SIPs, ISAs.
Yes.
So you could switch, like he suggested, you might be able to switch to more of an income base from the ISAs. So there's a tax-free income coming out of those as well.
Mm-hmm.
So I think you need to take it back to brass tacks. How much does mum need to spend
to live? Yeah.
To live. How much comes out of the state pension? How much comes out of the civil service pension? Where is the difference made up? But yeah, the beneficiary SIP is the most logical one because it's tax-free.
And there is a saving to IHT if she spends that money and income tax on the beneficiaries.
Yes.
So that's the 67% off sticker, isn't it?
It is.
So I would be looking to spend that down and potentially draw more from that and start giving that away. I think if I was planning, there's a sum to be done on how long can that money last. In fact, he does say something about it, Lester, well into three figures, doesn't it?
Yes.
Just from the SIP. In which case, then, I think there is an argument to draw what she needs from the SIP first and come up with a figure that says, okay, well, how much extra can we draw from the SIP? If she's 79 now, say for it to last to say 95 or 90.
Yes. Yep.
So a reasonable decade or more. And give that excess away from there.
Yep.
If she absolutely needs to dip in, she could do that from the ISA, but hopefully not. That's the point. Just draw what she needs from the SIP and draw a bit more and give that away. And you kind of got the best of all worlds there.
But actually what Stephen could do, and what we've asked Stephen is how long would this last? If you've allowed sufficient within the mum's beneficiary SIP to take her to 90, 95, whatever you decide is a fair term, you could actually have the rest of the beneficiary SIP out in one go.
Yes, true. It's tax-free in her hands.
It's tax-free in her hands immediately. So
give it straight away.
Yeah, and give it straight away. So instead of saying it's going to be 4 or 5 years, allow for some sort of calculation for your mum that says, okay, of the beneficiary SIP has got to provide her with this much extra income on top of the state and the civil service pension.
Just to meet her needs.
And the income to meet her needs. Anything in excess of that, it can come out in one go.
Yeah, it could. Really.
And then you start your 7-year clock from that now, effectively.
Yeah, I mean, you can cover lump sum gifts. If she's in good health, she could take out a bunch of sort of, they used to call them gift inter vivos policies.
Yes.
7-year life insurance policies. They don't really do those anymore, but you can do, there are some firms that will do collection, like a collection of 1, 2, 3, 4, 5. So one that lasts for 3 years.
Oh, right.
And one that lasts for 4, 5, 6, and 7 years.
Oh, yeah.
So, to cover what the IHT will be at the various points from the date of the gift. And, could fund that from ISAs.
Yes.
Literally. So, okay, if that's going to cost her 150 or 250 quid a month, well, could she draw off her other capital to fund that?
Yeah.
Because that will itself also reduce her income tax.
Yeah.
Inheritance tax,
Inheritance tax.
So there is a bit of swings and roundabouts going on here. I just think, is there anything else? There was one comment that we wanted to put
you said that you were taking money from mum's beneficiary SIP to fund ISAs, which reduces the IHT liability.
Which it doesn't.
Whether the money's in a SIPP or whether it's in an ISA, it's still subject to inheritance tax.
From 27, as far as the SIPP is concerned.
Yes. But the ISA is already inside IHT liability.
Yes.
So actually, I don't know if there's a bit of confusion by the way you've worded it or confusion with your understanding, but taking money out of a SIPP to put it into an ISA doesn't remove it from the IHT liability from 2027 at all.
No, I think you might be right there. Maybe Stephen just is thinking, well, anything him and his sister get from the SIPP when mum dies, they're going to pay both income tax at additional rate and inheritance tax on. So it does, excuse me, it does make sense then to shift from SIPP to ISA from that point of view. But inheritance tax position is unchanged from April 27. Yes, you could shift the ISAs to a yielding thing. So Stephen is essentially thinking things through broadly correctly. Yeah. I don't know, to answer his first question again, I don't know that there is a definition from HMRC as to what constitutes income. Could she draw out 100 grand a year and call that income? I mean, technically, yes.
Yeah, technically she could.
It's going to be in the lap of the inspector, though, isn't it? I feel
because especially if subsequently she then has to access capital because the SIPP is gone. So I think there might be a bit of balancing the books here and saying, okay, what's mum's spending requirements? Where does it come? So start at the bottom, and then say how much can we take from the SIPP to cover that, and then anything in excess of that.
I'd put very good money on that not being written down anyway, wouldn't you?
Yeah,
that it being largely at the whim
of the tax
inspector. Yeah, but keep good records. We had a good question a couple of weeks ago, didn't we, from somebody who was doing their IHT 403 forms.
Yes, and had everything in place.
All the record keeping. So it's a great question, Stephen.
I think you're thinking along the right lines. It's just a case of exactly where that money's going to come from. But
yeah, obviously we can't be too unequivocal because it's advice then. But hopefully that gives you some stuff to think about, Stephen. Good question, though. Right, this is you.
Number 3, this is from Rob. Says, hi, Pete and Roger. Thank you both for your continued help in navigating the financial maze, and I'm enjoying the listener questions. Good. My wife works part-time and is a basic rate taxpayer. She pays into her workplace pension and contributes an additional 15%.
Good job.
Her pension provider receives 20% tax relief on these contributions. I am a high rate taxpayer and I make contributions to a SIPP. My pension provider receives 20% tax relief and I claim an additional 20% directly from HMRC. As a couple, we could stop making the additional contributions to my wife's pension and instead make them into my SIPP. This would give us an additional 40% rather than her 20%. Mathematically, this makes sense. We haven't done this so far, as I like the idea that we are equally contributing to both of our pensions for the future. It also helps keep things simple. I am mindful that one day we may kick ourselves for not making this simple switch, which may leave us with a significantly bigger pot when we need it. What options would you consider in this decision of splitting pension contributions? Many thanks, Rob.
Okay, well, I'd say this is one of those things where there's, potentially there's quite a few questions like this in sort of financial services. It's sort of the maths is one thing and potentially the heart says another, but really this is like 40% tax relief is better than 20%.
Yeah, I mean, why would you not take it when you can? But emotionally, it's like, well, actually, I'm overdoing my pension, and my wife's not having so much in her pension, and there is this thing we've always talked about, having your own money for yourself. So when you get to retirement, I suppose it makes financial sense on the mathematics. The worry would be is if Rob is going to be a high rate taxpayer in retirement,
and he has more of the money,
and he has more of the money, that
somewhat undoes. Yeah, particularly if Rob's wife's pension perhaps gets eroded more quickly because it's smaller, and spends it down. So now they have to draw much more from Rob's pension, pay more tax on it. It might just undo some of the benefit, but that's kind of hard to quantify because there's a lot of unknowns in the future, isn't it?
Yeah.
We do this quite a bit. You can potentially redress the balance because if, bear in mind, one of our kind of golden rules is like benefit now.
Yes.
If you have to choose between benefit now and later, you would choose it now. So it probably makes sense for Rob to bank the additional tax relief. But you could redress the balance a little bit by saying, well, he's got a bigger pot, so there's a big tax-free cash payment, PCLS. Could then, even if it's not paid into a pension because they've retired by then and she doesn't have relevant earnings, but some of that money could go into her name.
Yeah.
they could ISA it together.
ISA it together,
you
yeah.
know, if it's really just about whose hands it's in, look, if you're a couple, you're a team,
Yeah.
that's less of an issue. For tax reasons, you may end up paying more tax in the future, but if you get more money in your
Get more money now,
I
then
would
you
choose
offset
that,
that.
I think.
Yeah, I think I probably would do it. And as Pete said, you could redress the balance when you draw your tax-free cash.
Yeah. I wouldn't overthink it. I think it makes sense.
Yeah, it
in
does.
this case.
Yeah.
Right, this is from Chloe. Question 4, dear Pete and Rog. I just wanted to say a heartfelt thank you for your podcast and the incredibly valuable information you share. Your conversations are not only insightful, but also reassuring as I start to think more seriously about my own retirement planning. Delighted, Chloe.
Yeah.
Thank you. One of the things I'm considering is retiring abroad, somewhere sunny. Spain, most likely. I recommend Seville. It's beautiful.
Yeah.
And I wondered if you might explain the process you go through with such clients. Specifically, do you have a checklist or a list of key questions that you typically ask clients to work through before moving overseas? For example, I've learned that ISAs are not recognised in many EU countries, so it may be better to sell before leaving. And I imagine there are similar considerations around SIPPs, UK DC pensions and other investments. Do you also tend to liaise with financial planners or accountants based in the EU when helping clients prepare for such a move? I would be very grateful for any wisdom you could share. Thanks again for all the work you put into the podcast. It really does make a difference. Warm regards, Chloe. I fear we may disappoint you, Chloe, a little bit.
Yeah, honestly, I don't think we've come across this situation much with clients at all. I've never advised anyone.
I've had one client move to Spain.
Yeah.
And two clients moved to Spain. And in both cases, their affairs were relatively simple. But because we don't have the licenses to advise expats, somebody who isn't resident in the UK, there's very clear sort of lines.
Yeah, that we can't cross.
Yeah, right. I mean, I did a podcast yonks ago. I'll try and find it. Nick will know where it is. Encyclopedic knowledge of the back catalogue. But I did do some stuff, a session on preparing to leave the country. Right. I think that was with Phil Billingham.
Okay.
Can't remember. So we'll find that for you, Chloe. Always keep a UK bank account. That's one of the things I always say. If you're going to go abroad, make sure you've still got a bank here in the UK. Obviously, you can access it online these days, so that's fine. But honestly, it's so much easier to get a UK provider to pay into a UK pension. So that's sort of job one. I think you want as little complexity as possible.
Yeah, try to simplify things as much as you can before you go, obviously, because it's far more difficult when you're over there anyway. I think because we haven't got the knowledge ourselves, I think it would be worth checking the tax treatment of all your UK holdings in the foreign country you're considering going to.
Yeah,
I do understand that ISAs aren't recognised abroad, but is it still better to leave the money in the ISA earning what it's earning?
Yeah.
And then making withdrawals and perhaps paying some tax in Spain? I don't know.
Yeah. What is taxed? Is it the withdrawals?
Is it the growth?
Or is it the growth? Or what? You need to know that, really, so that you can make a decision. And all that information will be freely available. It just needs a bit of digging. There are also, like Reddit communities, Facebook groups of expats who may be able to help you. People who've done it and have gone before you. One thing we always say, right, the advice regimes in a lot of other countries are very, very different to what we have here in the UK. Honestly, we don't know where born. UK regulation is so good. Standards are so high in this country compared to overseas. There's lots of cold calling. There's lots of very high commission products, lots of very high exit fees, lots of just expensive on the ongoing fees products as well. Most countries don't have super low cost direct to consumer platforms like we have in the UK. So, tread carefully and tread particularly carefully with advisors. All right. I'm sure there's some good ones, overseas advisors, but the whole system is set to be less attractive than getting advice here in the UK just because of regulatory reasons and costs on products as well.
But I suppose the nice thing is because there are so many expats in Spain, wherever you're going, there might be expat communities that will be able to guide you in who to see over there, who's done it well. There could be WhatsApp groups or whatever, I don't know. But chances are you'll probably get a lot of information from existing expats. Yeah. Because if you're considering going over there, I'm assuming that you've taken some holidays over there and are looking around. You may have some friends in Spain already that you might consider just talking to.
Yeah, worth a look. We can't really offer you any more than that, Chloe. Kind of wish we could, but this just seems to be, that's like the extent of our knowledge on it, really. So tread carefully, do your homework, simplify, keep a UK bank account. Watch out for non-UK advisors. Question 5, Rog.
Question 5. This is from Oscar. What a lovely name. It says, "Hi, Pete." Not so lovely now.
Not so lovely name.
Love the podcast. Very informative and user-friendly.
Thank you, Oscar.
I have a question, once popular, but maybe not so much now, and one that will make advisors sweat again. Ooh, don't like those ones.
No, interesting.
I'm a sophisticated investor, so to speak. I manage my own SIPP, etc., and I'm an accountant, so I guess I have a head start over most people. I have a net worth, excluding my house, of around 2.5 million, spread across SIPP, ISA, FIC, which I guess is a fixed interest.
Well, you said that. It's a family investment company.
Family investment company, possibly.
Potentially.
Yeah. And GIA. I also have an old DB pension. I'm 59. It pays out around about £6,500 from the age of 65. My dad died at age 63. Given my circumstances, I want to transfer the DB scheme into my SIPP. I have 2 children, so would like them to get it rather than die with me, so to speak. The last transfer value I got was pre-COVID at around £100,000, which I know isn't a brilliant multiple, but I'm happy with that. I'm fit and healthy, but I'm not relying on the guaranteed pension given my other pension provisions.
Okay.
So, firstly, is it likely the transfer value would have gone up or down given the increase in interest rates? And secondly, do you think I could get a positive recommendation from an advisor? Thanks, Oscar.
Not from us.
No.
Transfer value's likely gone down, hasn't it? Because interest rates have gone up since pre-COVID.
Yeah, because what tends to happen is each scheme, Oscar, has its own basis for calculating transfer values and the estimates and the what they're imagining might happening with your pension fund. So, but what generally happens is if interest rates go up, then you need less money invested to give you the fund you need to buy the income you need. If I say it in that way. Yeah. So with interest rates having gone up now, chances are it may have gone down in the meantime.
Yeah. CETV is cash equivalent transfer value. And essentially, it's a today's money capital figure. The actuaries have worked out what all your future pension benefits will be worth. So it's quite a complex
it is,
sum.
yes.
I mean, this interest rate's one thing, inflation expectations, assumptions on longevity, personal factors, the funding position of the scheme itself. There's a whole bunch of variables.
Yeah,
so
right.
It's not just going to be the case of interest rates up, CETV's down.
No.
Not quite as simple as that, but probably quite likely to be.
Yeah, somewhere around there.
One has to question, you had a sort of before we hit record, you said, this seems relatively small beer in the context of...
Pension transfers, DB pension transfers are difficult anyway, and they're quite expensive to do. And what I'm thinking, you said to me, excluding the value of the house, you're worth about £2.5 million, ignoring this DB pension. And you're concerned about losing something that might be worth £100,000 not going to your children. When in my books, they're probably already going to receive about £3 million net, subject to IHT. By all means, think about the consequences of these things.
Yep.
But I'm just wondering whether, with the difficulty of making pension transfers and the cost of doing so, whether in this instance you might say, well, actually, I will take the income as a supplement, knowing that I'll work hard in making sure that whatever I've got left goes to the children in a good and timely fashion.
Yeah, definitely agree with all that. I would look at taking it early. I would look at commutation factors of tax-free cash.
Yeah.
You don't know. And I would look at funding a whole of life with the income. If you're fit and healthy, Oscar, you could say, well, I'm going to take out a life insurance policy for the $100,000. It probably won't cost you that much. You know, you get a sort of what they used to call maximum basis. So basically a fixed premium for life as opposed to a reviewable premium. You don't want that. Premiums skyrocket in later life. You get a fixed premium whole of life insurance for $100,000. I mean, if you are, 59?
Yes.
You know, that might cost you, I don't know, £200 or £300 a month, maybe. But your DB will pay considerably more than that. So maybe you just draw the DB early, fund a life insurance policy, put it in trust. You don't need the income. Yeah. And you've essentially drawn out your pension, haven't you?
Yeah. And with respect as well, although your dad died at 63, that doesn't mean you're going to die at 63 or 65. You could draw the pension either early now, and there'd be some reduction factors for you for that, or take them from 65. You could live to 90. You don't know.
No.
So drawing £6,500 for 25 years.
It's a decent chunk of money.
It's a decent chunk of money instead of taking 70, 80, 90, 100,000 pounds out as a lump sum now. So
yeah, you could give the excess as well as a gift
instead
from
of
excess income. So I wouldn't treat it as binary. It's like transfer or not. You know, you can draw that early. You can use it to fund it. I would definitely be looking at that. I would get quotes for that and look at doing that. And it just kind of ticks that box. It's dealt with. Just make sure the life policy is placed into trust.
Yeah.
Look, you're right. It costs a lot of money for a firm to do a DB pension transfer. It's very much the deep end of the pool in terms of expertise, in terms of the work needed to be done, in terms of regulatory scrutiny. So that's why, I mean, if it cost you less than $5,000 to do that pension transfer, I'd be amazed.
Yeah. And that as a percentage of the potential value for what benefit you're getting, it's really quite difficult. And you might find that your standard of living means that actually they'll say you ought to have the DB and all the rest of the stuff you've got. You know, you've got a lot of wealth around you, but there's no guaranteed income from it.
Yeah.
So your standard of living might be based upon your guaranteed living requirements, and the DB scheme might be one of them. So you might approach somebody for advice to transfer, knowing you're very knowledgeable about what you've got, and it makes sense to you, but they might still turn around and say to you, we're not going to recommend it, and they charge you a big fee for not recommending transferring.
Yeah. That's the way it works.
Yeah.
If any company you speak to is prepared to do a pension transfer on an insistent client basis, in other words, yes, I take your advice that you don't want me to do it, but I want you to do it anyway, then that firm is to be avoided. Good question, Oscar. I think there's some nuance in your thinking that you might want to just consider. And the final one, question 6 from James. Dear Pete and Roger, love the podcast. I'm a bit more of an adventurous investor than you usually caution, but you provide a certain passive tracker yin to my property investment yang. I love it. Given your backlog, I'm going to ask you a pension question that I probably don't have to think about for 20 years, so you've got time to get to it. I like James. I worked in Denmark for several years and paid into a pension scheme while I was there. I believe it is structured similarly to a UK DB pension scheme. There is an initial lump sum plus an income for life. This pension fund is not covered by QROPS, that's Qualified Registered Overseas Pension Scheme.
Yep.
So there is no transferring my way out of this complexity. That sucks. Never mind. The Danish pension fund thinks I'll be paying Danish income tax, presently 37 to 38%. ChatGPT is adamant that I'll be paying UK tax. Who's right? I feel like we're stuck in the middle here.
Yeah.
If taxed in the UK, I can imagine getting the tax-free cash allowance right might be complicated. Is there anything else I should be considering? I'd be amazed if there's tax-free cash. So, Nick, our genius friend who helps, to say that he helps us is a gross understatement of what he does. So, Nick very often will just sort of do a bit of research for us and look at sort of prompts, give us some prompts for the, before we hit record. And he found the UK Denmark double taxation convention treaty. As amended by the 1996 protocol. Apparently it's been in force since 1980, this agreement, amended in 1996. And Article 18, brackets 2, I kid you not, we believe means that this would be taxed in Denmark, all right? Which would suggest that if there's a tax-free element, it's paid in Denmark.
Yes.
What happens when you bring it into the UK, I don't know. But one would hope it's no longer a pension payment and it's your money.
It's classed as capital that you're bringing into the country, I would have thought.
We hope, but we don't know.
No.
The income, though, would be taxed in Denmark, so at Danish rates. You should not pay UK tax on it again, because of the double taxation agreement. But I don't think there's anything you can do about this, which you've kind of got to that point yourself. Yeah,
it depends what other I presume it depends what other income James might have when he's in the UK, because you get this double taxation, so you get a tax credit for the tax you would have paid in Denmark. And therefore, I'm thinking, well, if you've got English income, British income, and you declare it on a tax return, would that credit offset some of the tax you would have paid on the English income as well? So if you would have paid 20% tax in the UK and you're being taxed at 37-38% in Denmark, does that tax credit reduce the tax you pay at 20% over here?
Good question. Don't know.
We don't know the answer to that question.
No, we don't know. And I don't know what else we can say, because this is not obviously a specialist field of ours. I think you're going to need to take advice, I think, to be sure whether that's now. I mean, it might change between now and when he retires. Yeah. Or does James say?
Doesn't say. No, it doesn't say.
No, he says he's got to think about it in 20 years, so he's presumably in his 30s or 40s.
All right. Okay.
But I don't think there's much more we can add to that.
I suppose it will be what it'll be. You just need to investigate it for the time being and find out the most tax-efficient way of doing it. I would have thought if there's an element of tax-free cash over there, once it's out and it's sitting in your bank account, you bring it to the UK, it's just transferring of capital.
Capital, yeah.
In my head.
Assuming he's got a Danish bank account. But I mean, isn't net result is the same, you'd think.
So I want to say Danish at this point. But no, Danish.
I thought we were going to hold hands and sing Que Sera Sera for a minute. Whatever will be, will be. Okay. Well, good job.
So I hope those answers were helpful.
Sort of, not that last one.
No. But if we've pointed you in the right direction and say, get some advice elsewhere, that really works as well.
Yeah, it works for us.
But do please keep them coming at hello@meaningfulmoney.tv with the subject line podcast question, and we'll try not to wait 20 years to get to them.
Yeah, hopefully not. We're in sort of broadly August questions at the minute, August 25, and this is coming out in February 26, so we've got some catching up to do. But that's it for this week. Hope it has been useful and or enjoyable. Hopefully both. Any links that we've talked about, go to the show notes, meaningfulmoney.tv/QA40, and we hope you enjoyed it. We'll talk to you next time. Thank you, Mr. Roger Weeks.
Cheers, Pete.
Cheers.